Almost every single person has at least once in their lives been to McDonald's. It is a strong brand with tasty food, but how is the company doing on the stock market? Well, if we take a look, we can see that over the past year, they are actually down by 1.5%, and over the past 5 years, they are up by only 45.68%. So when we jump to charting and compare McDonald's to the S&P 500 over the past 5 years, we can see that they have actually severely underperformed the market, mainly over the past year, so from 2024 to 2025. Now, what you have to understand is that a company's intrinsic value isn't based on its short-term stock price movement. So the fact that McDonald's is down by 1.5% over the past year doesn't necessarily mean that it isn't fairly valued. So let's see if McDonald's is actually overvalued compared to their historical PE ratio. So let's go to valuation, select the PE ratio and the price and update the chart. And let's see over the past 10 years, we can see the blue line, which is the price, moving up very steadily, while the orange line, which is the PE ratio, is staying anywhere between 20 and 27. And actually it is also staying between 20 and 27 over the past 1.5 years, when the price dropped by 1.5%. So there is no sign that with their declining stock price, McDonald's would be overvalued compared to the earnings they generate. So jumping to our stock valuation spreadsheet, we will plug in the ticker MCD for McDonald's and wait for all the metrics to show up. And by the way, as always, if you want to download these spreadsheets for your own personal use, you can always do so in the link in the description. Now, first of all, we can see that McDonald's is a dividend company. They have a very decent starting dividend yield of 2.42% with a dividend payout of about $7 and a trailing free cash flow payout ratio of above 50%, sitting at 68.22%. Now, as all of you know, I don't like the trailing free cash flow payout ratio to be above 50%, as that means that the company has less than 50% of their free cash flow after they pay out their dividends to direct into innovation, share buybacks, raising that dividend, and paying down debt. So I'm really not a big fan of McDonald's trailing free cash flow payout ratio. Now, another thing we can see is McDonald's high debt. If we have a look at their market cap sitting at $209 billion and their enterprise value sitting at $261 billion, the difference between these two is essentially debt. So McDonald's is sitting at about $50 billion in debt, which to me is quite a lot compared to the market cap, making up about 25% of McDonald's total market capitalization. So let's have a closer look at if McDonald's actually might have an issue paying off their long-term liabilities. So jumping to the 9-pillar analysis, let's have a look at the 9th pillar, which is the long-term liabilities over the 5-year free cash flow negative dividends, and tells us whether McDonald's generates enough free cash flow to pay off all their long-term liabilities. And generally, we want this ratio to be below 3, and we can see for McDonald's this is sitting at 9.99, which means that with the free cash flow they currently generate, they would take about 50 years to pay off all their long-term liabilities while paying out their current dividend. So these are the two things I dislike about McDonald's: their high long-term liabilities, essentially debt, and their high trailing free cash flow payout ratio, and both of these put their dividend into risk. Now, jumping back to the 9-pillar analysis, let's actually have a look at the consecutive dividend growth of the company. And we can see that they have been consecutively raising their dividends at a rate of 7.16% yearly. If we zoom into this pillar, we can see that their dividend growth is higher than the average company's dividend growth, and their dividend yield is as well higher than the average stock dividend yield. But the high debt and their high trailing free cash flow payout ratio might put this nice dividend growth at risk. Now, what you have to understand is that McDonald's has very loyal customer base. So if we have a look at their profits growth, we can see that their revenue has been growing on average at a rate of 4.5% yearly over the past 5 years. Their free cash flow has been increasing at a rate of almost 11% yearly over the past 5 years, and the net income has been increasing at a rate of 14.24% yearly. So they have some very decent growth in their profits. And what makes this even better is their high and growing 5-year profit margin, sitting on average at 54.27%. So if we zoom into pillar 6, we can see that the profit margin grew from 52.33% in 2020 to 57.12% in 2024. And so with the growing profit margin and with their growing profits, it is quite possible that McDonald's will be able to lower their trailing free cash flow payout ratio flow and pay down more debt in the years to come, and therefore making their dividend less risky. Now, another thing I like about the company is that they have decreasing shares outstanding at a rate of 1.09% every single year, which means that you as an investor will own a larger percentage of the company with years to come. Now let's also direct our attention to the 5-year PE ratio, which for McDonald's is sitting at 27.76, while we want it to be anywhere below 22.5. And this essentially tells us that over the past 5 years, McDonald's has been overvalued compared to the earnings they generate. But if we zoom into Pillar 1, we can see that McDonald's has actually been successfully pushing their PE ratio down over the past 5 years, and currently it is sitting at only 25.64, which is lower than the 5-year average. And therefore we can see that McDonald's is actually trading less expensive compared to what they have been trading in the past. So now that we have gone through the fundamental 9-pillar analysis, let's calculate McDonald's intrinsic value, first using the Graham's formula revised. And here I plugged in the 5-year earnings growth estimate at 8.10% yearly. I then took the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and got an intrinsic value of only $164.97, which is 76% lower than the current trading price of the company. Now what we have to understand is that McDonald's is a very well established company that is trading at a premium, and that means that investors are willing to pay more money for $1 of McDonald's earnings than they would be willing to pay for a different company's $1 of earnings. But even though they are a premium company, for my taste, their premium is a little too high. But we still have 3 more valuation models to go through. So let's jump to our discounted cash flow model, where we plug in the free cash flow growth over the past 5 years and calculate the average growth rate to be sitting at 10.95%. Now into the future, I predict a growth rate of 7.3% and calculate the future free cash flow. I then plug in a discount rate at 6.4%. So basically the minimum rate of return I want from my investment yearly, and I calculate the present value of that future free cash flow using the discount rate. I then take the sum of that future free cash flow, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value of $316.46, which isn't that much higher than the current trading price. Now let's also compare McDonald's to some of its competitors such as Yum and Starbucks. So we will take these two companies' current stock prices and divide by their earnings per share to get their PE ratio. We will then average these PE ratios out and multiply by the earnings per share of McDonald's to get an intrinsic value of $299.80, which is almost the same as the current trading price, showing us that McDonald's would probably be considered fairly valued to its sector. And finally, moving to the final valuation model, the dividend discount model, we take the dividend growth over the past 5 years and calculate the average growth at 7.15%. Now I will project a slightly lower growth rate into the future due to their high debt and their high free cash flow payout ratio. Now because the projected growth rate is higher than the discount rate we plugged in, the intrinsic value comes out negative due to the mathematics within the model, and therefore we will use our alternative model and get an intrinsic value of $307.47. And finally, moving to the ultimate valuation, we will average out the 4 valuation models and get an intrinsic value of $272.18, which is 6.62% lower than the current trading price. Now if I was to remove the Graham's valuation, the intrinsic value would come out to $307.91, which is about only 5.5% higher than the current trading price, and with a margin of safety of 15%, the acceptable buy price would still be sitting at $261.73, which is lower than the current trading price, so the company would currently be a hold. Now it is very clear that McDonald's has very great value to it. I personally won't add it to my portfolio unless it falls even more in its price. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps me out.